Welcome to the new modes panel. Now, earlier today, we heard a lot already about AI, Gen AI, LLMs. Our challenge for this panel is to zoom in more specifically on the moat, on the elusive issue of competitive advantage. And we will try to distinguish between efficiency, a temporary edge, and a true sustainable edge, specifically in investment management. And to do that, we have a couple of PhD on the panel across the data companies and research firms, investment firms. My name is Robert Ciemniak. I'm the founder of Robotic Online Intelligence, a platform for automation of market research and custom deployments. But I also run an independent research firm focused on China property markets, so visiting freshly from Hong Kong. Now, before we dive in, I also wanted to show you a little piece of paper I've got here. And it's not a magic trick, but just to prove there will be no sleight of hands, I'll put it on the table and I'll come back to that at the end. So a little bit of a suspension. So without further ado, what we would like to do is to first go through very specific use cases of LLMs investment management. And then the second part, we will discuss more openly the competitive edge question. Dan, could I start with you? You're with the giant S&P, and what do you do by way of introduction, and 1-2 cases that really excite you about what you've seen work in the firm?
Great to be here, Robert. So Dan Sandberg, I oversee the quantitative research and solutions team for S&P Global Market Intelligence. I usually describe the team as being like an internal client of S&P. We get to use all of the content, all of the data, all of the analytics under the umbrella, the way that we believe clients are using the content. And we document the journey in white papers. We produce coding notebooks that help clients replicate the work, and we create new products. For the last few years, we've been experimenting with generative AI, and we've been thinking about how to develop, as you say, the long-term and near-term competitive edge. It's been a real exciting adventure the last few years. I say, you know, as it pertains to long-term competitive edge, it's hard to say where or when we get to a place where AI has surpassed the human contribution, but it's a very real possibility that we end up there at some point. Imagine, if you will, a world in which AI can perfectly process all information, not just what's in the public domain, but everything behind the paywall, all the S&P stuff, all of our peers' content, everything that's available to process. And if that were to happen, if the AI were to perfectly process that information, then there would be no need to compete. There would be no longer any difference of opinion in the markets. And so at that point, competitive advantage becomes sort of a non-existent,
like a death of markets.
It's death. What would that look like? I sort of do a thought experiment and welcome everybody to do it with me. You know, what would that result in? And I think it's a system where those that need capital end up borrowing from the investment pool at a cost of capital set by the AI, based on the risk inherent in that company. And the investor would receive a fixed rate of return based on their time horizon, their liquidity needs, the tax and other considerations that may be important to their investment process, maybe ESG constraints, for example. So at that point, we'd all be out of a job. And most of the folks listening would probably be doing something very different than they're doing today. But we're not there yet. right? We're not in that world today, and we have to go through a probably decade or more before we get there of AI and humans working together. We're not at this singularity market, if you will. We're not at the investing singularity where the AI has subsumed the human. We are in it together. And so the advantage today is around, in my experience, three things: avoiding mistakes, providing the right context, and scaling the insights. And I can give you examples of all three of those in a concrete way. Avoiding mistakes is about having a mechanism where your process, if your process is stochastic, if it's variable, if it produces a generative output that is non-deterministic, then that output needs to be grounded in some sort of auditable data. It needs to track back to something that the human can verify. And so, for example, we have a flagship AI platform called Pronto NLP that produces features on any document. You could bring your own document. It'll produce features for you. And what I love about this platform is that every feature has a justification generated by the AI with a link back to a direct extract from the source document. So it's auditable. That's one way to avoid mistakes. The other is, and I hinted at this earlier, to focus more on deterministic processes and less on stochastic processes. Earlier this year, we published a paper called Questioning the Answers. And what we did in this piece was we took every single question and answer in the corpus of earnings calls and we vectorized. Now, the vector embedding process is not stochastic. It's not generative. It's a deterministic process. And that vector embedding produces now a numeric representation of the text. We then used, we took these two texts, the question and the answer, we lined them up, we vector embed them, so now we're in a numeric space, and we then use the cosine similarity, which I'm sure many are familiar with. I'm not going to go into it here. It's a way of assessing whether those two vectors are close together or far apart in vector space. And what that means in a real world way is whether the question and the answer are semantically related. We've done all of that processing. We've been able to quantify and to score an executive's response on an earnings call, whether they answer sell-side questions on topic without doing anything generative or stochastic, but still using AI.
So using this example on earnings calls, I guess this is on earnings transcripts. So two quick questions. You did mention auditability in terms of traceability, but how do you go about evaluation? How much human work is involved? Because my sense is, and from our experience in financial services, unless you really put a human to review the output, it's difficult to assess. And B, can you share briefly a bit about the technicalities? So, for example, did you use some open source model, some commercial model? Like what is under the hood in this scenario?
Sure. The first question on auditing depends on the application, which is a vague answer, but I'll add context. From S&P's perspective, we're about providing features. So these, the output of this NLP model is not a buy or sell recommendation. It's a label. And we have done what we feel to be a sufficient amount of validation that we are confident in those labels. We've produced some of those statistics, which I don't have off the top of my head. But if you were a quantitative investor and you were using this signal without any other inputs, then I would imagine that your validation process would center largely around successful and missed trades. And if you miss a trade, if your AI has steered you in the wrong direction, I would imagine you'd then try to disentangle whether you got the right output, but that output was not what was driving the stock, or whether you got the wrong output. If you're using it, and we're seeing more and more of quantamental, where you're doing sort of a quantitative feature extraction, and then that becomes part of a mosaic that you mix with other data, then you don't really need to do auditing at scale. You can look at the particular case that you're examining and dig deeper. So if you're, again, as an example, looking at mentions of tariffs and how tariffs are going to impact margins, you may be interested in a set of companies, and you find programmatically find all of the mentions of tariffs, and then you would go and independently validate those to meet whatever downstream process you were plugging that into.
So I'll come back to you and also on the model, just to bring in other perspectives. But have a think in the meantime on the tough question, which is that, yes, so you will sell this product to multiple or many funds, and where's the edge for anybody in that, if you can buy that? Hold that thought. Could we move, Spenser, to you, still staying on that heavy quant part? I know you also done quite a lot of applications. Could you explain, introduce yourself, a bit about 𝐸𝐴𝐼𝐸 and one-to use cases?
Yeah, thank you, Robert. I'm Spenser Marshall. I'm the Chief Information Officer at 𝐸𝐴𝐸. 𝐸𝐴𝐸 exists to produce research and curated data that's entirely generated from alternative data for institutional investors. So in my role, I manage our data science team, engineering team, and our AI development team. When we think about what a defensible moat looks like in the near term and the medium term, we think that it's differentiated and proprietary data that your foundational model has not been trained on and does not have access to, that you can use as an input. That by itself is, I think, not a very contrarian or differentiated opinion. I think it's echoed by many. What we've found in deploying Gen AI for generating data analytics is that the trick is not just having proprietary information. It's about having the context, the semantic layer, the tools that you can give to your AI, our clients' AI, or our clients that aren't using AI in order to use the data in their investment process.
So the whole orchestration layer around it.
Yeah, orchestration, but I would say specifically the semantic layer and the knowledge graph. I think orchestration and observability, I think there's a litany of really powerful tools. That industry is evolving quickly. We've been happy with the LangChain tooling that we use for orchestration, observability, and evaluation. But what LangChain can't give us is a powerful semantic layer that lets our agent or our client's agents know, hey, what data matters to generate this type of insight on this type of company that is relevant to an investor, that's going to be part of the narrative around a company, right? So I was thinking about your thought experiment, Dan, which is, when we finally reach market efficiency, how do you maintain alpha, or how do you maintain an edge? I guess in your thought experiment, there no longer was alpha or edge. There was an AI that was a capital allocator. What it got me thinking about is, when I started in this industry 10 years ago, we were working with consumer transaction panels that had 2 to 3 million users in them, right? Today we have 100 million. I would have thought once we had gotten to 100 million users in a US consumer transaction panel, that retail stocks would be derivatives on the data, right? Like 100 million consumers in a panel should have pretty perfect representativeness. It's not quite the case yet. The stuff is hard to work with. Data always has some form of bias. People upstream may have made some errors in processing the data before it gets to you. So even though I think we're further towards market efficiency, the tools that are being developed now will get us further there yet. It seems like it's an asymptotic approach, and there's still a lot to be done as we approach that asymptote.
But it sounds like your emphasis is on that semantic layer, and if we zoom in again back to that differentiating point that you have built proprietary knowledge graph structure that overlays the data with proprietary elements, advantage to you, back to the same question, where if you're a provider to the funds, how does it make a difference, like from their perspective? And we can maybe come back to that, and let's come back to it in a second. Now, turning to the investors and investment funds, Mike, could you tell us similarly, like where do you, with the background, and where are your cases of deployment?
Happy to do so. Mike Sauce, I'm the Chief Investment Officer at Milburn. We are a macro quantitative fund trading futures FX. Past life, I've traded equities at other places. I've been at Point72, to name one. I think when it comes down to the Gen AI and think about the investment process, and that does go from collecting data, and even the first is, what do I even want to look at? That's another question. Then what data am I collecting? And that's one where Gen AI can really be a great tool to collect and package together the multitudes of data that a human no longer can do. Then there's, how do I synthesize and turn that into a trade? And so I want to break it up in those three pieces because I'm not so sure I've had a lot of success with Gen AI saying, what exactly do I want to look at? And the synthesis part is difficult, but the data and data collection and making features works very, very well for us. So I've worked with a number of folks, vendors, partners, even in the early days. Let's parse all the Fed minutes, parse all the reactions to the Fed minutes, and let's figure out the sentiment of what does the Fed think about inflation and monetary supply. Does a really wonderful job of distilling all those different points. The one little piece it doesn't do well is predicting the price action, right? So it can do lots of stuff except make the money. And if you think about what Gen AI actually does, right? You take ChatGPT, it can take all the views out there and distill it into the wisdom of the crowds, the wisdom of the masses. But the best investments are when the crowd is wrong, right? You don't make any money by understanding where the crowd is unless you're willing to understand what they got wrong and go to where they're not. And so there is that human element that's there that is missing in the Gen AI. So I think similarly to, shops that say we use machine learning back in 10 years ago, or hey, we use computers in the 80s and 90s. That in itself is not the entire strategy. And so I think there's a little bit of irony in the sense as Gen AI builds up, there's been a massive race to get that talent and the tools on board, and they are important, right? You can't run a fund today without using computers, but you also wouldn't just hire a bunch of programmers and say, I have an investment firm. And I think the same way, you have a number of college graduates coming in with amazing abilities to build ML infrastructures, pipelines, use the tools. Any 3 computer science grads can jump in a garage and really start a firm, if you will, by collecting data from a lot of funds and AWS account. The tricky piece is getting that investor wisdom to add on top of it for that synthesis step. And I think in some ironic way, that's going to be the competitive edge, I think, of funds, is having people who have that old school wisdom, knowledge, and understand the markets in addition to the technical side. In a very strange way, that technical side is now, you almost have a glut of supply, or I think you will have a glut of supply of all the engineers coming out and the Gen AI tools. Because from a moat perspective, if I built a moat today, in 24 months, I think it's obsolete. So I think the idea of building a moat to protect yourself technologically is difficult unless it's cultural and organizational.
The people point, I think, is a good template for a pitch for people to justify their jobs going forward in your sector.
Well, if I'm back next year, you'll know it worked.
Now, turning to Warren Buffett, to Ehsan and his value investing angle and more academic angle. Could you share a bit of your use cases with Crescendo, but also what you see? I know you ran a conference recently at Columbia as well, where you see most action.
Sure. Delighted to be here. I'm Ehsani. I'm Executive Director at Crescendo Partners. We're a value-oriented and activist firm based out of New York. We also sponsor SPACs, currently looking for a target for 91. My exposure to Gen AI, besides working with some solution providers and experimenting with some use cases at Crescendo, has been mostly because of the research I've been doing for the last couple of years at Columbia Business School, when I'm an adjunct faculty member. And as was mentioned, we recently also organized a conference on Gen AI investment management. So when it comes to the question of whether Gen AI can provide a moat, I agree with what was just mentioned, that I think it will give investment firms that utilize this technology an edge, but this edge is transitory, because as data and solutions become more and more abundant, everybody will have access to them, and therefore that technology edge goes away. And at the end of the day, it becomes a situation where most of the investment firms, in terms of tech stack that they're using, they'll be very similar. So when most of the players in the sector have similar technology, similar data, similar type of solutions that they use, then I think they're going to win or lose by execution. So, and execution at the end of the day comes down to talent. So I think, in my view, what will happen to buy side from impact on the headcount is 10 years from now, buy side will be something like a sell side today. 20 years ago, in the sell side, in a bulge bracket bank, we had maybe 300 analysts. Now, in the top 10 banks, maybe we have 300 combined. So I think similar things happen on the buy side. But from the skill set perspective, the players or the analysts or the portfolio managers who remain and will do better than others are the ones that have a pie-shaped skill set structure, in the sense that they have a broader range of skill set, and then they know finance and trading and what makes a winning trade, as well as technology and Gen AI know-how.
I think it's quite interesting how just observing that how the two panelists who are on the investment side brought up people, and on the research and data side, it was much more tech-driven. Maybe just coincidence. But still on the technical thing, I just wanted to zoom in on one thing that I often find there's not enough talk about this. So operationally, that's more for Mike and Dan. When we talk about deployment of LLMs, back just to specifically that, what do you actually do? Like, is these open source models fine-tuned to your specific proprietary data? Is it commercial models? Can you share, but just briefly, what's the dominant mode, or what you see others do?
I could take the first stab at that. We've done both proprietary modeling and off the shelf. I have made the analogy that an LLM is sort of like a new college graduate. And I think the model coefficients, the training that LLM has, is sort of like the major or the coursework that the LLM has taken. And so for most applications, a decently educated, sort of college grad benefits more from improvement in the instructions and examples, which would, in this analogy, be the prompt and the context, rather than sending them back to college to go get another degree. There are exceptions, of course, where you want to fine-tune an LLM for not a generalized purpose, but something more specialized. And we have seen some success in that area. But even in that case, I don't see massive value to be gained from starting from scratch. With a lot of the AI efforts we have in-house, we have started with Llama 3.8. We're not wed to that, and it could change, but we started there, and we benchmark performance to the off-the-shelf, and then after refinement by providing some additional training examples, about 100,000 or so, to get some fine-tuned performance. And we found that that fine-tuning did make a difference. But again, unless you have a repeatable and specialized task, I don't think you need to go send your LLM to get that graduate degree. I think the college degree is probably the right starting point.
And cost consideration is a big factor.
Yeah, I largely agree with you, Dan. The truth is, we don't really care as much about who's winning on the foundational model side, because we're going to run it all through our eval framework, and we're going to see what works best for us. What's creating generations that we know are grounded, accurate, representative, they're retrieving the right information. Also, to Dan's point, the trick there is what you've built around the foundational model. And the truth is, that's really what a company like 𝐓𝐡𝐞 can control as well, where it's not like we're going to be creating a foundational model. And so making sure that we're getting our prompt engineering right, that we're getting our context right, and making sure that our eval framework is as robust as possible, which in my opinion is particularly important in financial services and particularly important in the investment community, because our standards for accuracy are generally quite high. Like, our businesses are built on the reliability of being able to disseminate accurate information. So eval is critical. If you're comfortable with your eval, then you're in a good place where you can be trying out a variety of models. So to get to brass tacks, for a while, we did try to use open source models. We fine-tuned open source models. We did some co-development with Databricks in that space. Ultimately, commercial models perform the best for us in our evaluation framework. So currently, we're primarily using commercial models.
I thought there was one other point you made earlier that's worth repeating, which is the knowledge graph. That is the way in which we transfer knowledge from that wisdom that we were talking about earlier that makes the difference. The way we transfer that to the AI is through that knowledge graph. And that's not just generalized knowledge, but company-specific knowledge as well. I think somebody said earlier, you know, it's not the Fama French factors or the factor zoo that's driving the stock price. It's usually something bespoke, something company specific. You know, for Netflix, maybe it's subscriber growth in Asia. For Apple, it might be iPhone sales, and for Rio Tinto, it might be the quality of the iron ore coming out of their Pilbara mine, and whether they're, you know, on cue for output given the latest hurricane that just hit. It's something that humans, I think, don't do very well, processing all those different data streams and being able to have a sort of company-specific view, but the LLM can do that very well.
And the reason I was bringing up those details is because that's, I would pose, is the area where potential edge might be in this sort of proprietary integration methods with proprietary data, with custom evaluation framework, where you can really differentiate on that. Now, on the investor's side, looking at Ehsan and Mike, so if we bring it to the people side of the equation, so maybe more generally, like, so in your operations, if you broaden it, so where does GenAI, well, not GenAI, but LLMs, that part, where does it fit in the broader consideration? How high on the priority list is it today?
Well, I think it's really high priority for everyone in the fundamental and value investing community. That doesn't mean that they've been investing tremendously and significantly in this area. I think last time I ran an informal survey, around 6% of the fund managers I spoke to were dedicating reasonable budget to this area. Majority of the people either use it for summarization of documents using generic Gen AI tools or extracting information from publicly available data. So I think from this perspective, they know it's important. They know it's going to transform the way investment processes will work. But unfortunately, they haven't. Most of them have been focusing on this in the form of a pilot or ad hoc usage with generic tools, and haven't seen really that serious commitment to it. That has been my observation.
Yeah, I think I'd echo that to a degree where there have been a number of, I think pilots and dabbling still by a number of players. We do use them for sure. And I think where we've had success, and Dan, I like your analogy of the college graduate. I think I'll steal that for my next panel. We have tried to take LLMs and try to predict a number of variables or get reads on what's important in the markets, and it doesn't really do that well. Where it does do well is if you, again, give that LLM a proper training and pay the tuition. And where it has worked out for us is if you take someone who does have 10, 20 years as an economics researcher, perhaps in the sell-side economics department, and you ask it about macroeconomic variables, and you have that dialogue, you train it, hey, what do you think? A, B, C, D, E, F. Nah, D and C are not that important. I wouldn't focus on that. And just constantly refine the LLM to focus on what the human believes is important and pulling those things out. Those have had more success for us. And again, I want to come back. It's not so much the make the trade on that information, but how can I use the LLM to take unstructured data, textual data, or even numbers, and distill that into data points, hard numbers that I can feed into my model. So that's one. And the other area where I think it's useful is not so much on, hey, give me a read plus or minus versus consensus, but even just a more generic, what are the themes being discussed? For a quant fund, the biggest danger is that the world tomorrow, something's different than it was 10 years ago. So you've built all these models and assumptions, and the world's changed. So having an LLM that can look at things, hey, what are the topics being discussed right now? If you built a model over the last 20 years, the question of U.S. Fed, independence, it was there, here, and there, but not to the degree it is today. Is that an emerging theme an LLM could find for you and say, hey, there's something different you want to consider right now in the market that's not in your models, some kind of a warning bell just to say, things look like they might be different right now. I can't tell you which way, but hey, heads up, get the humans to take a look in a certain area.
Yeah, I mean, if you use it well, it can actually bring down the cost structure in a fund. Because right now, many mainstream platforms that are used by investment firms, they're almost like buying TV channel bundles. Like you want to watch the, ESPN, you have to buy cooking channel and all these other stuff too. Gen AI is very different in the sense that you pay by consumption, but you need to be able to implement it, properly. So the ones who are more purposeful about where the edge that they have in their investment process coming from, keep that and then use automation for the rest of it, I think are the ones who are going to be more successful. And one more point that I want to add in terms of exciting things that I've seen is a focus on voice and video. The LLM have mostly been focused on extracting information from textual data. One of the things I've seen a couple of funds have been experimenting with has been focusing on voice. Case in point, let's say if you're in a conference call, an analyst asked a CEO whether they like to do more tuck-in acquisitions, and CEO says no, versus scenario where he says, no. These voice-based systems can produce signals out of those situations where a traditional LLM system might fall short.
One thing that I think we are saying here, or you're saying here, is that there are these sort of applications and on the component solutions, and somebody also mentioned on the few panels earlier, LLMs do what they do. They can summarize, they can classify, they can do those things, and you can include that in very simple or complex process. But there's also, I don't know here if Dan or Spencer can comment on this one, there's this view, and it came from Jan LeCun and a few others, on that maybe LLM's game will be over soon, because we need to move to the world models and how the world really works and those new frameworks. So do you still feel there is a much more upside of what LLMs can achieve in specifically, not in general, specifically in the stuff you work on? Or you think we are kind of hitting at that incremental improvement level at the moment?
Yeah, I mean, I think we're hitting, in terms of the efficacy of the technology itself, I think it's pretty obvious that we're hitting the incremental improvement level. Where we're seeing a deceleration in how new models are performing on benchmarks, right? I don't think that's a crazy idea. We're seeing diminishing returns. In terms of if LLMs are, the model spec of the future, probably not. I mean, in our practice, if we can do something deterministically and still have the output or the product that we want, we will, right? Because like we were talking about earlier, we're in an industry that demands accuracy, and the hallucination problem is not perfectly solved yet. But I think I don't raise this as a cause for alarm because, among quant practitioners, LLMs are just another model spec in a series of model specs, machine learning model specs that we've been using for decades, and that evolution will continue, and LLMs will continue to have their place in performing and will likely continue to be best in class at performing certain types of analysis. Like, for example, research coming out on the efficacy of LLMs on OCR or voice analysis. LLM is going to be a great model for that, in my opinion, for a long time to come.
Yeah, I mean, I would agree with the statement that the sort of incremental benefit of the next model is probably on a decline here. There might be another leg up. There might be another breakthrough. I'm not even entirely sure I have a fully formed view on the iteration of models, but in terms of whether we've gotten the value out of the LLM, I don't think we've even begun to scratch the surface.
Agree.
So what we're saying is, on the one hand, you need to be really pragmatic. In investment management, high accuracy requires certain things, and I don't get too excited. I need to be practical about this, but within that, we haven't yet necessarily reached the creative potential. So we have 1 minute left. I pulled out this little piece of paper. So to walk the talk a little bit, what I did before the panel, I ran some deep research on every panelist on their background and also what they are likely to say based on what they say in the past. So I had the profile ready, what to expect. And they know about this, but then what they don't know, and that's what's written on this paper, they also ask it to write the conclusions from this panel before the panel. So I will give maybe Dan an honor to read it out.
I saw my bio, but that's Google searchable. This is pretty fun. Okay, so the conclusions, according to the LLM, are moats come from proprietary unstructured data pipelines, domain ontologies, and RAG. I don't know if RAG, but probably
First two's pretty good.
First two's good. Could be RAG, next gen, maybe MCP. Human in the loop beats automation. Interpretability and model risk controls are mandatory. Quant migration to private markets needs alt data, precise retrieval, and rigorous validation. I had some points on private markets I didn't have time to make that are a bit of a departure from that, but we'll have to save that for the next panel. I think this is actually a pretty good summary.
So that leaves some food for thought about the future of conferences as well, and future of our panelists.
I'm
and
out.
with that food for thought, I think you'll enjoy your lunch break, which I believe is coming next. So a big thank you to the panelists. Thank you.
Thanks, guys. Thanks, Robert.